Two investors, two $500,000 properties, and the same 10 years. One ends up worth $672,000 and the other $983,000. Wherever did the other one go wrong? I've been personally investing since 2018. I've bought over 50 properties for clients and I have a $7 million property portfolio myself. Well over 7 mil, but close enough. And the difference wasn't actually luck. It was understanding what actually drives growth. Most investors spend their time chasing yields or the fresh coat of paint or the beautiful cosmetic renovation, the newer build home. And no joke, they lose 7 figures of growth in the process. So in this video, I'm going to cover off the worst types of properties and the ones you should be avoiding in 2026, the fundamentals that make a property truly investment grade, and how to avoid wasting years of financial progress in the process. Now, before we get into all of that, I want to share with you the biggest trap, or the thing that people think is what gets them ahead, but what actually doesn't, and that is the cash flow trap, which is that people think that the best property is the one that yields the best, or that the rent covers the repayments, as people say, but that's just not true. And I'll tell you why. I had a client that bought a $400,000 property, cash flowed really well, the yield was great, but barely any growth. They had $400,000 tied up in this property. They were making a couple of $100 a month, but there was zip in terms of equity growth. The opportunity cost in year one alone was hundreds of thousands of dollars. Well, actually, it was $120,000. But who's counting? I'm counting. Property isn't about if it grows, because that is just a baseline expectation that property will appreciate in value over time. But it is about how much it grows, because you only really have a couple of purchases at best, if you're lucky, in your lifetime. For the average punter, that is. Think in terms of opportunity cost, not in terms of will it grow. That is a very poor way to judge a property investment and will cost you hundreds and hundreds of thousands, if not millions of dollars, if you think that way. Now, let's get into it. Let's talk about the types of properties to avoid in 2026. So, first cab off the rank is the high yield, high cash flow, low growth properties. They will get you nowhere. The number one trap that I see people falling into is they're chasing yield over growth. That's a big no-no. High yields usually mean that the relationship between supply and demand just is not as tight. There's not as much pressure on that market for prices to appreciate. Again, there are exceptions to the rule here, but as a general rule of thumb, if you're chasing yield, you're chasing cash flow, those are not going to be the markets that are probably going to perform the same way as a lower yield, higher pressure market over the long run. So if you're looking for capital growth or equity growth in your property portfolio, which you should be, you need to be looking at the long-term price trends, seeing how this market has responded over the long term to give you an idea as to what your typical compounded annual growth rate will be. Not just the one that's looking good today or tomorrow or next year, unless you want to be trading in and out of markets, which you don't want to do. Anyway, if growth is behind in terms of the long-term average and you're looking for that equity growth or that capital growth, then walk the other way. You'll be doing yourself a favor. Now, if you are investing for yield or for cash flow, you've already got a big portfolio and you're just looking to add more assets to the portfolio without impacting your cash flow too much, that could be a solution for you. But if your goal is capital growth, buy the family home one day, and you need to take a big dent out of that mortgage, if your goal is to build a portfolio, continue to draw down on equity and reinvest it, then those cannot be the properties that you have in your portfolio, not the only ones anyway. If you like, you can download my property questions you must answer before investing. The link is below. Might come in handy. Give it a crack. Point number 2 is property in oversupplied areas. Many people think cranes and new estates and new infrastructure and think, oh my God, great, growth. All that it means is construction. You have to look deeper than that. Remember, an oversupply can be many things that you don't want. Flat growth, no pressure on rents, high vacancy rates, and just investor-dominated markets that are just oversupplied. Think about like a new housing estate that's just been built. Think a brand new tower or Mascot or Zetland here in Sydney, Alexandria. These are all areas that have a very clear and distinct oversupply. Avoid them like the plague. Because the truth is, if you're competing with dozens of other identical properties, that is going to kill your growth. There is going to be no pressure for competition. There are going to be no buyers out there competing for the stock that is going to push prices up. And that is precisely why you need to stay away from those markets. My advice is, if you see that there are huge developments underway, whether they be unit blocks or a brand new estate in a growth corridor with, thousands of lots or hundreds of lots that have been rezoned, steer clear of those markets. There is a very high risk of oversupply. Number 3, you want to be avoiding cheap stock in weak markets. Cheap or affordable does not mean good value. It just means cheap. And it can mean low socioeconomics. It can be low demand, low job growth, poor infrastructure, and just simply a market that maybe not many people want to live in. Or, on the flip side, a market that is oversupplied. A $200,000 to $300,000 house in a dead market could make you $50,000 to $100,000 in 10 years. You don't want that. Don't be that guy or girl. On the flip side, a $500,000 property in a growth market could make you $500,000. You would double your money over a 10-year period, which is exactly what you want from these affordable, low-supply, high-demand markets. And once you know what to avoid, spotting the real performing markets becomes easy. So let's talk about properties that consistently perform over time. I think the common myth is that performance is random. No one really has a crystal ball. Well, true, no one has a crystal ball, but performance is predictable. There is all this array of property data available on SQM Research or CoreLogic or Cotality, and the fact is it can really increase the odds of you picking a winner. So, investment-grade properties share 4 key traits. The first is strong land value or strong land-to-asset ratio. The majority of the dollar that is spent on the property, believe it or not, this applies to houses and units, is made up of the land component. For example, buying an older established house on a 600 square meter block versus buying a newer, shiny, flashy new house on a 250 square block. The prior house, or the first one I mentioned, has a much stronger, higher, better land to asset ratio, a higher land component. The same goes for units. Buying an apartment in Bondi in a block of 6 has a very high land to asset ratio. The underlying land component on the land tax assessment you get from the State Revenue Office will show that you actually have a very strong land value. Those are the things that will help you buy the winner. That property is going to consistently and in a big way outperform the unit in a block of 40 apartments in the same suburb that's brand new. Not to mention the strata will be much, much higher on the latter. Nobody likes strata. Number 2 is scarcity. So there is just an undersupply of property. That you're in an area that is not zoned for dozens or hundreds of more lots or more units or apartments. You must be buying in an area where there is an underlying low supply and there is no future line of sight to heaps more supply. That is going to be what keeps prices on the up. Number 3 is owner-occupier appeal. We want to be buying in markets that are owner-occupier dominated and that have owner-occupier appeal. Why? Because owner-occupiers are a few things, actually. They hold their properties for the longest, so they're less likely to flip their properties every 5 to 10 years, keeping supply low. But even more importantly, they are emotional buyers. They spot a house that they love, and they really want to buy it because they can see their kids playing in the backyard, or they can see their family swimming in the pool. These are the buyers that are going to buy emotionally and pay top dollar. Number 4 is looking at properties that are in markets that have a proven track record of success and growth over the long run. There can be periods of flat or negative growth, that is fine. But if you look at the long-term trajectory of those markets, you should see strong patterns of long-term growth. And that is what we want to see to ensure that we're buying good foundational growth assets. You also might want to overlay this with looking at the particular cycle that market is in. For example, if you're seeing properties in markets that have had astronomical growth the last 4 or 5 years, you might start thinking to yourself that, hey, these markets are maybe getting unaffordable for their residents. Therefore, demand might start to shrink, especially if income growth, which it definitely hasn't, has not kept up with the pace of property prices. If properties have doubled in the last 5 years, you can bet your bottom dollar that wages haven't. So you've got to take that demand factor into consideration and understand that demand may start to fizzle out. So do yourself a favor, run all of the properties or the markets that you're looking at through that 4-point checklist, and you'll be well on your way to making a good investment decision. And if it ticks all 4, you've found yourself probably an investment grade asset. Now, let's quantify the real cost of getting this wrong, shall we? So most investors ask, the normies will say, did I make money? That is the wrong question. The real question is, how much could I have made? So let's run through an example. We've got 2 $500,000 properties. Property A, 3% growth year on year, is worth $672,000 after 10 years. Property B is a 7% compounded growth property, is worth $983,000 after 10 years. That is a difference of $311,000. Same start, same decade, vastly different result. Now you go and scale that over 20 years or across multiple assets, that is millions and millions of dollars that you or whoever did this has lost. So the wrong property doesn't just underperform, it actually blocks your ability to continue, it blocks your compounding growth effect, and in reality, whatever your goals are, whether it is to buy the dream home, whether it is to retire early, to become work optional, all of those dreams or those wants or those desires or objectives get delayed because of the decisions that you're making today when you invest. So my advice is to compare anything and everything you look at to the investment grade alternatives, not just against your benchmark of will it make me money or will it grow or will it pay itself off. That's not the aim. The aim is capital growth. So look at the 10, 20, 30-year growth data. Look at the supply and demand metrics. They're available online. CoreLogic, Cotality data, property, SQM Research, all of these platforms, you can access the data yourselves. If it doesn't stack up, walk away. Opportunity cost will be the thing that kills your portfolio, not did it grow. And most investors only realize this mistake when their equity lags behind. Don't be that guy or girl, of course. If you want, you can book a free call via the link and I'll help you pick out the right ones. That's my job after all. So, knowing what to avoid is the first step. The next thing is having a system to actually pick the right assets, the right stuff. In the next video, I talk about how I make $17,000 a month from my property portfolio. Well, kinda. And the exact process behind my $7 million portfolio and my over 50 client transactions or deals that I've done. Click the link on the screen and I'll see you there. Toodaloo.